The first and major thing that we're going to discuss is the collapsing of the Silicon Valley Bank. Why that has happened, my opinion on it as a progressive CPA, and really we're going to take a look at in the second portion of the segment on debunking why wokeness is not the reason that the bank failed. You might be surprised by that. Probably not if you have any grounding in reality. But of course, that's the world that we're living in, and everything has to do with some form of connection to wokeism. So, with that, we will dive right into it, and we're going to talk broadly speaking here, and then we're going to go into some of the clips of right wingers. So, to start, the Silicon Valley Bank is, of course, in Silicon Valley, and it is one of the largest banks in the United States. Supposedly, based on assets managed, it was about 16th. Of course, banking regulations in this country are not good, if I want to put it nicely. If I don't want to curse. And banking regulations in this country have been degraded since definitely since the Trump administration, but we definitely want to go back into the thick of things further to understand how we end up with one of the largest banks in the country collapsing. And there's multiple reasons for this, okay? So let's rewind. Let's go back to 2016, let's say, or even 2015. If you go back to the 2015-2016 election, you might remember the that crazy white-haired guy, Bernie Sanders, ranting and raving about something called Glass-Steagall. This was a bill, I believe, passed in 1933 in the response to the Great Depression. Now, Glass-Steagall was a bill that essentially made it so that the type of bank you are, I'm trying to use it in the most normie phrasing that I can without getting into the weeds too much, is an investment bank is not the same as just a bank where you would put your money as a regular depositor, right? So there's certain restrictions that a bank would have if you put your money in as a deposit in a savings account, as a checkings account, and how a bank can loan or invest that money. Now, we go from 2016 to 1933. Now let's fast forward all the way to Bill Clinton's administration. And to be frank with you, off the top of my head, I don't exactly remember the year, but in the Clinton administration, Glass-Steagall was repealed. And so basically what this means for us is that many of us, our entire lifetimes, or the majority of our lifetimes for those born, in the 80s and the 70s, at this point, the majority of our lives have been impacted by a deregulated banking system, which has led to not one, not two, arguably three, if you want to go into, stock crash, if you want to go into the Great Recession, if you want to talk about COVID, and now maybe this, there's different arguments. Like, let's take COVID out of it, but the potential of a third recession now being caused by deregulation in banking and investing. So, where does this all kind of boil up into Silicon Valley Bank? Well, what happens here is you have a bank that, and this all connects. I have to lay out the history because it all connects. We're going to go back to 1929 soon. But Silicon Valley Bank is unique in some way. And it's not because it's woke, as we will go over. But the main uniqueness of the bank is that its size is just small enough to be under the threshold that would be regulated by the Dodd-Frank Act of 2009, passed under the Obama administration. Now, Dodd-Frank was a step in the right direction for regulating banks, but it was not Glass-Steagall, and it was not building upon what Glass-Steagall did, like beyond the regulations that it needs, right? So we needed to reinstate Glass-Steagall, and we needed to go further and protect in not investors necessarily. I mean, although I think that we should protect investors, as we'll talk about, but you need to protect depositors, and you need to make sure that people that are getting loans that they can actually afford. And talking about the failure of expertise, of course, loops back in here, because a lender shouldn't be giving money to somebody that they know can't pay it back. So that's, again, where the Great Recession comes in. Now, SVB, similar concept, except instead of mortgages, you're dealing with tech companies. Now, you may or may not have heard that in the last couple of months, the last maybe year or so, there have been major layoffs in the tech industry. Now, this is from a variety of different reasons, but this is for a variety of different reasons, say. But the lack of liquidity, and I'll talk about liquidity in a second here and, break that down. But the lack of liquidity for these companies means that they cannot pay their employees, or that they cannot cover costs without getting loans. Now, remember what we talked about last week. When the Fed raises the interest rate, it is harder to get loans because they cost more. And if businesses can't get loans, businesses that don't make money can't pay the people that work for them. And believe it or not, and this might actually be shocking to some people, some of the biggest corporations, maybe not the biggest corporations, but some of the most prominent corporations that you could think of in the tech industry don't make that much money. What happens is that they're highly leveraged, and they borrow a lot of money on the speculation that someday they will become profitable, or they will become a monopoly like Amazon, or they will become a sort of I don't want to put it. They'll have a stranglehold on what they'll have patents, or they'll have some sort of monopoly of service or good, basically. And that's what makes them valuable. They could either be acquired, or they could be their product or service is just so valuable that they make billions and billions of dollars. Now, if you are, say, someone that is an accountant, or you're a financial manager, or whatever, if you work in the industries like this, you've seen companies, you've maybe audited companies, I have, that make absolutely no money. They speculate on the potential profits. They lose all their money. They go out of business. Right? So what ends up happening is, based on however they were formed, some people get paid their debts, other people don't, and they get off, right? SVB was one of the most highly leveraged banks, I should say, in the country, with over 90% leverage investment. So basically meaning, if you have X amount of assets, let's just say $1 million in assets, meaning cash, equipment, machinery, take you back to accounting 101 here. If you invested $500,000 of that, that would be a 50%. If you invested 1 million, you'd be at 100%. So with 90%, that means that 900,000 of the 1 million is invested and is leveraged. Now, remember, this is how banks make money. So if banks are not regulated, they're going to be more likely to leverage themselves in a more aggressive way because they're playing with other people's money. What do I mean by that? By playing with other people's money, I mean they're literally playing with depositors' money. When you put your money in the bank, they lend that money out and they get interest on the loans. That's how they make money. Now, let's just use Google as an example. Google's not a good example here, but let's just use them because everyone knows Google. If a company like Google were to come in, let's just say Bing instead, right? I know Bing's owned by Microsoft, but let's just say that Bing existed in isolation. Said, hey, we're a startup company and we want to do a search engine that's a competitor to Google and do all this stuff, right? Wonderful. SVB is going to lend them money. Let's just say $1 million again. And that $1 million is going to be used to pay for payroll. It's going to be paid for, paying rent, marketing expenses, all this different stuff, right? But if that company fails, that's the risk that the bank takes. However, if the businesses, all of these different businesses and the owners in these businesses, because a lot of the businesses are owned by the pass-through entities. So what happens is like I could own a pass-through entity and ultimately, I get liability protection from my corporation. So you can't sue me, but I get the money from the corporation. If my money that I put into SVB is at risk, or I think it's at risk, it may cause, as this is what happened, a bank rush. Which, here we go, takes us back to 1929 into the Great Depression, where people rush the bank to get their money out of the bank. What happens is when you're over leveraged, when you have 90% of your investments in non-liquid, and remember, I said I would come back to liquidity, but liquidity basically means that you have money, you have cash, or you have short-term investments that could be liquidated or sold for cash. So what happens is everybody starts to go into they start panicking, right? All these people that have a lot of money, come back, because that's important too. They have a lot of money in the bank. They need to get their money. I need to get my money. I need to get my money. I'm going to run to the bank, pull my money out. Okay, maybe Connor OHanlon, I get my $1 million out of the bank. I'm okay. But maybe, you in chat, or you listening at home, or you listening on YouTube, or somebody that's going to comment some nasty stuff on the video. We're all rushing the bank. We all need to get our money out of the bank. There's no money. Because the bank doesn't have it because it's invested. So then they have to sell their investments. But while the interest rate is going up, the liquid investments that they have end up losing money because their interest rate on those short-term investments are too small. So they lose money. And if all of these things line up, the bank goes kaput. So I know that's a very elaborate, convoluted way of kind of understanding what happened here, but that is what happened. Essentially a mirror of 1929, a bank rush to a bank that was overly leveraged in speculative markets. They have their investments and their money tied up in companies that don't make money, and they can't liquidate it. They can't pull it back. And that's what happens. Now, the bank collapsed, and it just so happened that the majority of the money that they had from depositors was uninsured. So you may know, or you may not know, but if you look at the deposits that you put into your bank, and I assume most people watching this are not the uber wealthy, as some people think that I am uber wealthy. I am not. I can assure you that. The FDIC, or the Federal Deposit Insurance Corporation, I got that right. They insure up to $250,000 in each account. Now, you may have learned that back in macroeconomics, or you may have learned it in your personal finance class in high school. I know I learned that in high school. And I remember thinking to myself, hey, I ever have that amount of money, which again, I don't, but if I did, wouldn't I want to move it around a lot? Wouldn't I want to make sure that it's insured? Wouldn't I want to make sure that just in case that it's under the threshold? And I do audits of companies and we do all this stuff, right? And what they do is they do something called a sweep. So it goes in and out of the account. It goes in and out of the account, whether it goes into, an escrow account or if it goes into, it just goes in and out. It goes back into the checking account so that they can pay their bills, right? That's how a normal way to reduce that risk happened. But all these investors or these depositors didn't have these set up. So now the bank collapses. You, me, and everybody else that has 10, $15 million in there, we lose all of our money. And there's another story as to why I'm going to hold off as to why people had that amount of money in this bank. I think more news will start to come out as to like the practices around that and the sweetheart deals that were being produced from that. I think as more information comes out, we will know, and maybe we'll return to that later. But what happens now is that the government has to bail out the bank or the depositors. And again, there's a philosophical debate to be had here. Maybe we can have that. But right now, the FDIC is going to guarantee all the depositors' money back. And Biden has assured that. Now, I personally think that it should solely go to the depositors. None of it should go to the bank. The bank should be, liquidated, sold, whatever you want to do with it. And I think that there should be reinstatements of both Glass-Steagall and the repealed pieces of the Dodd-Frank Act, which was repealed by Donald Trump, which I may have forgot to mention. All of that is to say, and again, I think we might loop back around to having the philosophical debate. I want to wait and see. My conclusion is not drawn as to whether it's morally correct or not to bail out these depositors. I think there is an argument in both ways. Definitely let me know what you think in the chat, but I've swayed back and forth. My initial reaction is we got to protect the average person, the consumers. But then again, who is putting more than $250,000 in the bank, which is everybody knows if you have over $250,000 in the bank, what is insured and what isn't. Like, let's be honest here. So that is why I say that the practices that the bank is engaging in needs to be public information. We need more information on that for me personally to feel comfortable drawing a conclusion.